Okay, so hello everyone and welcome to our day 4 of this webinar conducted by ACCA to help students giving exams in coming attempt. Okay, so our agenda for today is option pricing theory, the Black-Scholes option pricing theory, but we are left with some stuff of yesterday's question because we haven't covered options yet. So we will firstly discuss options with you, and then we will proceed towards the option pricing theory. Okay, so yesterday we discussed 3 hedging techniques. The first hedging technique was FRA, forward rate agreement. The second hedging technique was futures, and the third hedging technique was interest rate options. So basically, in all techniques, the main basic thing was the rate fixation. Like in FRA, we used to fix a rate for a future transaction. Okay, in interest rate futures, we basically fix a rate, but the difference is standardization. And in interest rate options, it's again rate fixation, but we only get a right, not an obligation. Okay, how to deal with FRAs, interest rate futures, and interest rate options? You were told that forward rate agreement involves actual return on deposit or cost of borrowing. It was very easy. The amount into rate of interest into time period over 12. Then add or less benefit or loss due to FRA, the rate which you are getting in the market and the rate of FRA difference to amount in time period over 12. It was a big decision on deciding whether it's a gain or a loss, and then it should be added or deducted. Obviously, in case of deposit, if you booked a rate at 4.82 and market rates became 4.5, you got a benefit. It increases return, so add it, else deduct it. Okay. Then we move towards interest rate options, which was a bit tricky. Interest rate futures, sorry. I told you that in interest rate futures, the borrowing strategy is sell now, buy later, and the deposit strategy is buy now, sell later. Okay. So basically, it was a format that you need to find number of contracts, borrowed or deposit amount over contract size into time period over 3. Then the basis rate, spot minus LIBOR less futures price, then unused basis, then future closeout price, then tick. And finally, outcome of hedge in case of increase and decrease. The first thing is the same, actual cost of borrowing or return on deposit, amount into rate of interest into time period over 12, then gain or loss due to futures. Now difference in futures contract price and the closeout price you have got into spot into number of contracts into tick, you get net benefit or cost. And finally, you have to find the effective interest rate. Now remember, as far as options is concerned, the format was easy. In case of borrowing, we take put option. In case of deposit, we take call option. Okay. So the reason behind that was in borrowing, I told you sell now, buy later. So sell now put, while in deposit, buy now, sell later. So call. Okay. You have to make 2 columns: LIBOR increase and decrease, exercise price, futures closeout price. You get it from futures. Exercise yes, no. Gain in basis points if yes. Total gain. Then actual cost of borrowing or return on deposit, and premium payable. That's premium into spot into contracts into tick, and you get net cost or return and convert it into effective rate. Okay, so let's move towards the question which we did. So just for your guidance, a quick reference that in Avan company, it was planning to receive 48 million on 1st Feb, which will be invested. That means deposited till 1st June. And there was uncertainty interest rates could increase or decrease by 0.9%. And the company was considering three hedging techniques: FRAs, futures, options. You were given data of futures and you were given data of options. You know that options data is given. So in options, there are two strike prices or two exercise prices. Okay, the two exercise prices are 94.5 and 95. We have to use both. You are given December, March, June call options, December, March, June put options. The figures in between are the premiums, but remember, only one column is relevant. Either call or put. We have discussed this in currency as well, that only one column is relevant, and it's quite easier in interest rates compared to currencies. Okay, so I just completed yesterday the thing of FRAs. That in FRAs it was 3-7. Before starting the question, you were firstly informed that you need to write 5 things from the question to be able to get a complete understanding regarding this thing. So what were those 5 things? I told you the first thing was today's date, then borrowing or deposit date, and till when borrowing or deposit, that is the ending date, and what was the case, it was of borrowing or it was of deposit, and finally the option or future, which option or future will you take. Okay, so we noted that today's date was 1st November given. We plan to borrow or deposit on what date? It was 1st Feb, and till when? Till 1st June. Okay, so I told that today is 1st November and we plan to deposit after 3 months on 1st Feb for 4 months. So it's 3-7, the relevant FRA. Okay, then we wrote the actual cost of borrowing or return on deposit. It was 48 million into interest rate. If it increases 0.9, decreases 0.9 into 4 months over 12. And then we discussed the gain or loss due to FRA. Okay, so basically we took the difference in rates, what you get, 4.89, sorry, 4.99 versus 4.82 into amount into 4/12. So both options should give the same answer. Okay, that's in FRAs. Then futures, we found the number of contracts. Step 1 was easy. Then basis, spot minus the interbank rate, less futures price. Which futures price? You will take March futures because you wanted to borrow a deposit on 1st Feb. Then the unused basis was a bit tricky. You took the basis risk to 1.15 into extra months. We wanted to deposit on 1st Feb. We needed a future of 1st Feb that we had to take of 30th March. So 2 extra months over total months from 1st November to 30th March 5. Then future closeout price in both cases, it was spot minus LIBOR, less unused basis than the ticks. And then finally, the outcome of hedge in both cases, if it's increasing or decreasing. So actual return on deposit was the same. Gain loss due to futures. So you took the difference in futures price that was given and futures closeout price. Apply the buy now sell later into spot into contracts and to take futures should also give the same answer in both cases. And then finally the effective rate to convert it into percentage. Okay. Now you should move towards options. Okay, so Avan company interest rate options. Okay, so I have told you interest rate options. Again, there are two things. Increase by 0.9%. And then decrease by 0.9%. Okay. Remember I told you this? Case one, LIBOR increase, LIBOR decrease. So increase by 0.9, decrease by 0.9. Okay. So there are some steps which you need to follow in this. The first step, exercise price of option. Okay. Step two, you need to take future closeout price that is going to come from futures. Third step, exercise yes or no. Then the fourth step, gain in basis points. If yes, then in fifth step, you need to write total gain. I've provided you the formula, don't worry for that. Then actual cost of borrowing or return on deposit. In that case, this was a deposit case, so actual return on deposit. Then premium payable. Finally, net cost of return. This will come to net return. And after that, effective interest rate. Okay, so this was the format I told you yesterday. See, LIBOR increase, decrease, take exercise price, future closeout price from futures, exercise yes, no, gain in basis points if yes, total gain. I have provided the formula of total gain, actual cost of borrowing or return on deposit from futures, and then premium payable. You have the formula of premium payable, net return or cost, obviously net return and effective rate. Okay, now pay attention and go to the question. Why I am focusing on format so much? Because let's suppose you perform badly in options. Still, you have made the format and have input many numbers. So obviously, if not full, you will get some marks. But if you don't even remember the format, you won't get any marks. Okay, so let's start with exercise price of options. Now, when you talk about exercise price of options, remember in the question, There are two strike prices or two exercise prices given. Which one to use? I have told you in currencies also, we have to work on both exercise prices. If more than two are given, you should use two. But if two are given, you have to work on both because minimum two strike price or exercise price workings is required. Okay, so let's start. I'm taking the first exercise price, that is 94.5. So exercise price I'm taking the first one is 94.5. I'm doing the first exercise price 94.5. Okay, now compare it with futures closeout price from futures. What is the futures closeout price from futures? So futures closeout price from futures is, remember in step number 4 of futures you computed yesterday, in case of increase and decrease both, you have already computed future closeout price from futures in case of increase and decrease. So in case of increase, it was 94.55, and in case of decrease it was 96.35. Okay, so we have exercise price 94.5. okay, future closeout price from futures in case of increase and in case of decrease. From where did this come? We have already computed this from futures step number 4. In case of increase it was 94.55, in case of decrease it was 96.35. okay, now the third step, exercise, yes or no. You need to write yes or no. What was the strategy? In deposit, the strategy was buy now, sell later. In deposit, the strategy was buy now, sell later. So apply the buy now, sell later approach. Apply the buy now, sell later approach. Buy now, sell later. Apply the buy now, sell later where I've written B and S, buy now, sell later. So look at the first column. Buy now for 94.5 and sell later for 94.55. Buy for 94.5 less and sell for 94.55 more. Exercise. Yes, we are getting gain. But here, right side, buy now 94.5 and sell for 96.35 later at a more price. Again, yes. So it comes to both cases, yes. Okay. No need to write this buy now, sell later now. In deposit, the strategy was buy now, sell later. The strategy was buy now, sell later. So buy for 95.5 and sell later for 94.55. More, yes, exercise yes, no. You only have to write yes, no. And in case of decrease, buy now 94.5 and sell for 96.35. Again, buy for less and sell for more, gain yes. Gain in basis points. So if you check the gain in basis points, you take the difference. The gain is 94.5 less 94.5, which is 0.05%. But in basis point, we call it 5 basis points. In basis points, we call it 5 basis points. And in the other case, 94.5, 96.35, 1.85%. So I told you 100 basis points is 1%. So 1.85% is 185 basis points. Okay. Any questions till now? I've done the half process, 4 stages. Only 4 stages are left. Shilpa, it's completely your choice. You can use any two. Yes, Abdul Wahab, you got it right. Okay, so I wrote the format to get marks. Exercise price of option. The exercise price of option is, firstly, I'm using 94.5. Compare it with future closeout price from futures. I've already calculated the future closeout price from futures. Apply the strategy to exercise, yes, no. Buy now, sell later. Buy for low, sell for higher price, yes. Gain in basis points is yes 0.05%, which is 5 basis points, and 1.85%, that is 185 basis points. You don't have the obligation to write in basis points, but since you're following my formats I have designed in such a manner, I have designed the formulas in such a manner that only basis points would work. So applying basis points. Now let's move towards the total gain. Okay, where's the formula of total gain? See, the formula of total gain I am highlighting: gain in basis points into number of contracts into tick. Okay, gain in basis points into contract into tick. So what is the gain in basis points? 5 into direct number of contracts. Remember the number of contracts on the last session, 32, into tick was 50. Enter. Total gain 8,000. Okay, equals to gain in basis points. What is the gain in basis points? 185. Number of contracts 32, tick 50. So gain in basis points into number of contract into tick, you get total gain 8,000 and 290, 6,000. Okay, then actual return on deposit or actual cost of borrowing, this comes from futures. The actual cost of borrowing or actual return on deposit from futures. You can also calculate it. I've told you amount. This was in FRA as well. This was in futures as well. This was in options as well. The actual return would be computed by taking amount into interest rate into time period over 12. We have computed it multiple times in both previous approaches. So in case of increase, it was 766,400. You can check. And in case of decrease, it was 478,400. Okay, this was the actual cost of borrowing or return on deposit. Okay, 766,400 came in case of increase, and in case of decrease 478,400. If you don't want to just copy, you need to calculate it. Return on deposit is amount 48 million into, if it increases by 0.99 becomes 4.99 into 4/12. Okay, lastly, premium payable. So there is a formula of premium payable as well. See, I'm highlighting. Everything is format based to gain easy marks. Premium rate into spot into number of contracts into tick size. Now, the biggest thing, premium rate. If you go to the question, there are many premium rates given. See, at the 94.5 strike price, there are many premium rates given: 0.342, 0.432, 0.523, 0.090, 0.199, 0.271. I've told you multiple times, only one column is relevant in option. So see here, it's a very easy rule. In case of deposit, we take call option. That's it. So in case of deposit, we are only going to take call option. All puts cancel. In deposit, we take call option. And December, March, June, which option to take? We have already decided right at the starting of the question where we noted the 5 things that we will take March ones because we need to borrow a deposit at 1st Feb. So we will take future of March. Okay. So in deposit, we take call option, cancel all puts. And obviously, we have already decided that we will take March one. So what is the premium rate? 0.432. 0.432 is the premium rate. Okay. Into spot. Spot is always 100 into number of contracts 30 into tick 50. Let's apply here. 0.432 is the premium rate. You have to select it. Call format into 100 into spot into contracts 32 into tick 50. 69120. Again, at this price, the same exercise price 94.5. The premium is 0.432 into contracts spot tick. Okay. Now net return. It's a very important question, whether to add or less. Now remember carefully. You have got gain. You have got gain. Okay. So, and you have actual return on deposit. So obviously gain will increase return, so add it. Gain will increase return, so add it. But you have to pay premium in options. So payment of premium will reduce our return, so deduct it. Now you can't learn again. That's not rote learning. That gain will be added and premium will be deducted. No. Let's suppose you have a question of borrowing. You will get cost on borrowing. You will get actual cost on borrowing. So premium will increase cost, so you have to add premium in cost, and gain will reduce cost, so you have to deduct gain. It's completely logical. Here you have actual return on deposit, so premium payable will reduce our return, therefore deduct, but gain will increase our return, therefore add. But if you have actual cost on borrowing, the premium has to be paid, it will increase cost, so add it, and gain will reduce cost, deducted. Okay, now net return, just take the sum of the last three cells, sum. G9 to G11, these three sum, 705280, J9 to J11, 705280. It's coming same. The answer of options can be different in both cases. In FRAs, both cases answers come same. In futures, both cases answers come same always. But in options, the answer of both cases can be different. Here it is coming same because both options were yes, yes. Had it been different, yes or no, so obviously the answer might have changed. So if the answer net return of your option varies, you don't have to worry. But if futures answer of both cases or the FRA answer of increase decrease cases varies, then you have to be worried. Okay, and you know the formula of effective rate. It's basically the net cost of return. So what is the net cost of return? G12 over 48 million, the amount of borrowing deposit, bracket closed, into 12 months over time period of borrowing. 4. Let me just add words to make it more clear for you. 408%. Okay. Okay, so we have got 4.408%, and you have got the answer in front of you. I've told you when answer of FRAs comes the same, it should be the same. If it's different in both cases, increase, decrease, you have to be right. Futures answer of both cases has to be the same. If it comes different, you have to be worried, but options can vary. If both cases are yes, yes, then only it will come the same. Okay, you need to copy this stuff, and I will just give you, I will take some questions, you can ask questions, and I would want you that the second exercise price is for you, the 95 one. You complete it yourself. I will just quickly do the solution here, and then we will end this. Okay. Yes, Salima. Aman Patra, step 2 is future closeout price from futures. So from futures, step 4, you have the future closeout price. You can just copy paste it. 50 is the tick. Ossipier premium was in cents and currency. Here, there is no chance of cents. That's in percentage. Evelyn, I told you that when we need to borrow or deposit on 1st Feb, we need future of 1st Feb. But futures or options are only available for a quarter, December, March, June, September. So obviously, if you need to borrow deposit on 1st Feb, you will take off March. No, Diane, the first step is exercise price. In both columns, we have taken exercise price of 94.5. So 94.5 exercise price has premium of 0.432. Sandon, it's the gain. Gain in basis points into contract into tick. So tick was 50. Arun, I have to use both strike prices. I've just taken the first one. I will do the second one. Mirror the net return in FRAs and futures will be the same, but in options it can vary. If we discussed yesterday, you should refer to the yesterday's solution. In the first step, we noted 5 things. Okay, we noted 5 things. And among those 5 things, we decided that since we have to borrow or deposit on 1st Feb, we need a future option of 1st Feb, but they are only available for December, March, June, September. So we will use the March one. Aman Batra, the formula of step 2 isn't here. It was in yesterday's class. Future closeout price came from futures. You need to go to futures technique, the last technique, step 4. From there, we are just copying the future closeout price. Fast premium can be added as well as deducted. You can't rote learn. Premium has to be paid. So if it's return, it reduces the return. Premium reduces the return, therefore deduct. However, if you have been given the question of cost on borrowing, so if there is a cost on borrowing, then premium increases cost, therefore add it. Kumari, you need to contact ACCA team. It's on YMU website. You have to take care of that. I can give you the last class lectures. Jacker, step 6 is just copy paste from futures. The actual return on deposit was present in futures. Step 6, we just copy pasted that. Faisal, we decided to exercise yes or no by taking the decision on our strategy. Our strategy is buy now, sell later. So buy for 94.5 and sell for 94.55 higher. That's game. That's exercise. Yes, Mira, you are right. Yes, Rakib. Yes, Noman, you need to continue. Usman, why don't you have the question? You should refer to the handouts tab, and there all day work questions is present. Yes, Jacker, it can appear, so you have to do the futures working also. Kautilya, Sri Kautilya, we cannot comment on this, that what is the chance of that coming, what is the chance of that not coming. Everything is important. You have to be prepared with everything. Okay, so let's just complete it by using the second exercise price. Second exercise price is 95. Okay. So just change it to 95. Same format, exercise price of option is 95. Future closeout price from futures. Step 2, that's already from futures, 94.55 in case of increase, 96.35 in case of decrease. Exercise, yes, no. So the strategy is buy now, sell later. Buy now 95 and sell later 94.55. Buy for higher 95 and sell for lower 94.55. Buy for higher 95 and sell for lower 94.55. Is it a loss? So no. But here, buy for 95 and sell for 96.35. Buy for 95, sell for 96.35 higher. It's again. So yes, gain in basis points. If yes, there's no gain. And here the gain is 1.35%, 135 basis points. Okay, total gain. No total gain here because there is no gain. Here the total gain is gain in basis points 135 into contracts into tick. Okay. Then actual cost of borrowing or actual return on deposit is copy pasted from futures. Remember, actual cost of borrowing or actual return on deposit. It's a return on deposit, so you just have to take it from here. In case of increase, we have already calculated. In case of decrease, we have already calculated 766 400 and 478 400. Okay. And finally, premium payable. Okay. So if you need to take the premium payable, so premium is the premium rate into 100 spot into contracts into tick. Now premium rate. Which option to take? Call option. 95 price call option. And obviously in deposit we take call option. Okay. And which option we have taken? March. So March call option premium is 0.121 here. Just change it to 0.121. Arrow premium has to be paid, it reduces return, so deduct it, but gain increases return, so add it. You get the answer. And since the answer is varying because in one case it was yes, in one case it was no. So the effective interest rates would be separate for both of them. Okay, and the first case, the effective interest rate net answer over amount into 12 over 4. It's coming 4.66%. And in second, it's coming 4.219%. This effective interest rate is the thing which you have to use to decide. Now, you have effective rates of all techniques. For FRA, we didn't compute it, but you can compute it. You have the formula. You need to compare effective rates of all techniques and which is the best one, which you should recommend. If it's a deposit case, in deposit, we select the technique offering highest effective rate. Obviously, in deposit, we want high rate. So in deposit, we will select the technique offering highest effective rate, whichever technique is offering the highest effective rate. But in case of borrowing, we will solve like this, and we will select the option giving lowest effective rate. So the main decision making indicator is effective interest rate. This ends our interest rate risk management and this question. You can ask any questions, and after that we can move towards the next. Yes, Blaine, you can write that one. Mohammad Yunus, all these 8 steps carry marks, so any step missed means you lose marks. The question asks you, I didn't add the premium, Sufyan, I deducted the premium. The question asks you that recommend the best technique. So obviously you will find the effective rates of all techniques, the FRAs, the futures and options. Okay, once you have the effective rates percentages, if the question is of borrowing, we will select the technique offering lowest effective rate, because in borrowing we want the rates to be low. But if the question is of deposit, we will again solve all, find the effective rates of all techniques, and in deposit we will select the technique offering highest effective rate. Gain in basis points. So the gain is the difference of first 2 steps. Exercise price and future closer price. It's coming 1.35%. I need to write in basis points. Yesterday I told you 100 basis points is 1%. So 1.35% is 135 basis points. Yes, Rikotali, you can do that. Shilpa, I will get back to you later on this. Yes, Usman, we can do it. Evelyn, in deposit, you are not worried about increase in interest rates. You are worried about decrease in interest rates. You are worried that interest rates may go down in deposit. So see that. Okay, now our today's agenda is basically the option pricing theory. Yes, Evelyn. In borrowing, you are worried about rates rising. In deposit, you are worried about rates falling. So what is this Black-Scholes option pricing theory all about? Okay, now before starting the option pricing theory, you need to understand the concept of what option is. Okay, Basically, before starting option pricing theory, you first need to understand the concept of what exactly option is. Okay. Option is basically a right. Option is basically a right. Okay. Let me make it clear for you. Let's suppose you are planning to invest in gold. Let's suppose you are planning to invest in gold. You bought gold worth $500. You're planning to invest in gold and you bought gold worth $500. Now, first thing, why did you bought gold? Because your feeling or analysis was that prices will go up. Why a person buys anything for $500? Because his analysis that prices will move up. Okay, so you bought gold worth $500 in the expectation that prices go up. Now, if prices go up, become $550, $580, you will enjoy again. But let's suppose prices starts falling. You bought gold worth $500 in the anticipation that prices go up and you get gain. Let's suppose prices start falling. You will end up making loss. Okay. Similarly, let's suppose you already have some gold, okay, and you're planning to sell it. You already have some gold and you're planning to sell it, okay. Let's suppose you sold your gold for $100. Okay, you sold your gold for $100. Okay. Suddenly you saw prices went up. Prices went up. And you were just thinking, what did I did? I sold my gold for $100. Prices became $150, $200. Had I kept it, I would have enjoyed more again. But you can't do anything. Okay. Again, I'm repeating. Let's suppose you plan to invest in gold. So you bought gold worth $500. That prices will increase. Suddenly the prices starts falling. You can't do anything. You will have to bear that loss. Similarly, you sold gold for $100. When you sold, the prices suddenly went up, and you're worried. Oh my God, what did I do? I sold gold, and suddenly prices went up. There is a market called options market, in which you can do one thing. You want to buy gold worth $500. You don't go and buy gold. You just go to any financial institution offering these type of services and tell them, I don't want to buy gold worth $500. I just want to buy right. Just give me the right to get gold for $500. Just give me the right. Don't give me gold, just give me the right to buy gold for $500. Okay. In case prices increase, become 520, 530, 550, you had the right to get gold for $500, and suddenly the prices became 550. You will exercise that right. You had the right to get gold for $500. You will exercise that right for $500 and sell gold for $550 and earn gain. But let's suppose you got a right to get gold for $500. Suddenly the prices fell. It became $480, $450, $400. You had the right to get gold for $500, but the prices fall. You can leave that right. You can leave that right. So it's very beneficial for you. Had you bought gold for $500 and the prices would have fallen, you had to bear loss. But here, you didn't buy gold. You just got the right. Right is option. Option is right. You just got the option, the right to get gold for $500 from a money changer or a gold dealer. You got the right to get gold for $500 in the anticipation that if prices will go up, become $600, I will exercise my right and get gold for $500 and sell it in the open market for $600 and earn gain. But if the prices fell, I will waive my right. Okay, so this is very beneficial for you. So the person who is giving you this right, because you are getting safe in this, had you bought gold for $500 and the prices fall, you would have ended up making loss. Here you just got the right. If prices increase, exercise that right, get gold for 500, sell for 600 and earn gain. And if the prices starts falling, leave that right. So the person offering you this right to make you safe won't give this right for free. He will charge you some premium to give you this deal. See how safe deal is it? If the prices go up, I will exercise it for $500 and sell in the open market and earn gain. But if the prices go down, I will leave it. The person giving you this option or right won't give it to you for free. Will charge some premium. Okay. Similarly, let's suppose you had some gold and you sold it for $100 and prices went up and you were saying, oh, what did I do? If you have some gold, you should not sell that gold. There's an options market. You just get the right, take the right to sell gold for $5 or 100. Don't sell gold, just get the right commitment to sell gold for $100. Option to sell gold for $100. Now, if prices go up, become 200 or 300, what have you committed? Right to sell gold for 100, but now the gold is being sold for 400. Leave that right. But if the prices fell, became $80, $70, you have the right to sell gold for $100. If the prices fall, exercise that right and sell for 100. The person would be compelled to take it from you for $100. Obviously, this is very safe for you. You sold gold for $100 and the prices go up, you can't do anything. You just took the right to sell gold for $100. If the prices increase, leave that right. Sell it over in the open market for 400. But if the prices fell, right to sell gold for 100, exercise that right. The person offering you this right won't give it to you for free. He will charge some premium. Okay. This happens in crude oil markets as well. Let's suppose you bought crude oil for $40 and the prices went up, right? It's gain. Let's suppose you bought crude oil for $40 and the prices went down. It's sort of loss. Don't buy or sell crude oil. Get the right option. I took the right to buy crude oil at $40. If the prices go up, become $45, I will exercise that right to get for 40. Take it for 40, sell it for 45 and incur gain. But if the prices fell down, again 38, 35, I had the right to buy for 40, but now the prices are down, I will leave that right. The person offering you this right won't give it to you for free. He will charge some premium. Okay. Similarly, you sold crude oil and the prices went up. Oh, what did I do? You just take the right to sell crude oil for $40. If the prices go up, you can sell it for 50. Leave that right. And if the prices go down, exercise that right, sell it for 40. The person offering you this right to sell won't give it to you for free. You will charge some premium. So if you take the right to buy anything, we call it, you have taken call option. And if you take the right to sell anything, we say you have taken put option. Okay, no matter whether you take right to buy or right to sell, no one is going to give you this right for free. He will charge some premium. So what's the use of Black-Scholes option pricing theory? This premium will be computed through Black-Scholes model. Now the role of Black-Scholes model is just to compute the premium you need to pay to enter into option. Okay, any questions? Or you can copy some stuff if you want. Thank you, Sufyan. Yes, Sri Kautali, can do that. Yes, Salima, you are right. Okay, now, so all the students who commented that finally we got the principle or the meaning of option, that's what the problem with options is. Now, if I tell anyone that you've got the options question, you just have to randomly do the calculation, and people are very much comfortable. Okay, this is the step one, this is the step two, and blah, blah, blah. They don't know what option exactly is. So this is helpful in calculations, but if the question asks you for discussion, then you would be blank if you don't know what option is. So it is important that you know the meaning of option. So if NVA for you can't again rote learn, we exercise or leave when prices fall or when prices rise. You have to think carefully. Let's suppose you took a right to buy gold for $100 and the prices became $150. How will you earn gain? You had the right to take it for $100 and it became 150. So you will exercise your right to get it for 100 and then sell it in the market for 150 and enter gain. But let's suppose you took a right to get gold for $100 and prices became $80. You committed, you got the right to buy for 100, not obligation. Prices fall. If you exercise that right for 100 to buy it for 100, prices are lower, you will incur loss, so you leave it. Okay, so if it's in your benefit, you exercise. If you similarly, if you took a right to sell gold for $500 and prices went up, you took a right to sell for 500. Now the prices are 600. You can leave that right and sell it for 600. But if you took a right to sell for $600 or $500 and the prices went down, you should exercise that right so that you don't incur loss. Okay. So the main purpose of BSOP, Black-Scholes option pricing theory, is to calculate the premium you need to pay to enter into option. Okay. How Black-Scholes model computes the premium. Okay, it's a 5-step approach and it will give you some 8-9 easy marks. Step one is you note down PA, PE, RS, and T. So what is this PA, PE, and RST? PA is called the current share price or the commodity price, whatever you are doing. PE is called exercise price. R is the risk-free rate. S is the standard deviation. And T is the time to expiry in years. Remember, the formula states that time to expiry must be in years. So if you are given 6 months time to expiry, you should not take 6 months, it's 0.5 years. If you are given 9 months time to expiry, don't take that, take 0.75 years, okay? Second, find exponential value power minus RT, okay? Then find distribution values called D1 and D2, okay? Then from the normal distribution table, find ND1 and ND2, okay? And step 5, finally find value of call and put option. Note this down, please. Sri Kautalya, BSOP is only for options. However, whenever we have options, we can apply BSOP there. Like you have options in currency, you have options in interest rate, you have options in investment appraisal. Wherever options apply, you can apply BSOP there. Okay, now the thing that I want to tell you is the first step, you need to note the current share price, the exercise price, the risk-free rate, the standard deviation, and the time to expiry in years. Okay, so these 5 things are likely to be provided in the question. These 5 things are likely to be provided in the question. They are provided: the current share price, the exercise price, the risk-free rate, the standard deviation, the time to expiry. All these are provided in the question. Okay. Second step, find exponential value minus RT. So R is the risk-free rate, T is the time to expiry, that's in power. E is the exponential value, and this exponential value always carries a mathematical figure of 2.7183. You can just apply and find exponential value on calculator. It carries a constant value, 2.7183. Okay. Now, after step 1 and 2, things are a bit complicated. As far as formulas is concerned, things are a bit complicated. Okay, that PA, PER, ST, they are given in the question. Exponential value minus RT, we found that as well. Now step 3, 4, 5, how to find D1, D2, the distribution values. Okay, as far as the formulas are concerned, so step 1 and step 2 is easy, but how do we get the D1 and D2? So D1 is basically numeric log ln, the function ln in your calculator, PA over PE plus R risk rate plus 0.5 S square, the standard deviation square, T over S root T. Okay, and D2 is D1 minus S root T. Okay, this is how you work towards D1 and D2. Okay, and after D1, D2, you have to find N D1, D2. That's distribution, normal distribution. So for that, you have a standard normal distribution table given in the exams. A standard normal distribution table given in the exams. Okay, read this last line. Read this last line. This table can be used to calculate ND, the cumulative normal distribution functions needed for the Black-Scholes model of option pricing. If D1 is greater than 0, what is D greater than 0? D greater than 0 means it's positive. D greater than 0, that means it's positive. Add 0.5 to the relevant number above. However, if D is less than 0 means it's negative. Subtract the relevant number above from 0.5. Now, I will tell you what does this mean when we do the question, but the important thing is that this table can be used to calculate ND, the cumulative normal distribution functions needed for Black-Scholes model. If D is greater than 0, D greater than 0, what is greater than 0? Positive. Add 0.5 to the relevant number. If D is less than 0, so what does this mean? Less than 0, it's negative. Subtract the relevant number above from and 5. Okay. Once you are done with this, ND1, ND2, then finally in the step 5, you need to find the value of call and put option. That's also not a worrying thing. To find the value of call and put option, see, you have the call C formula, the first one. C is equals to PAND1 minus PEND2 E minus RT. And you have the put P formula, C minus PA plus PE E minus RT. Okay. Now, whenever we teach this topic in the classes as well, people ask, and I have a question here as well. How are these formulas derived? Okay, that's not a concern for any AFM student because it's mentioned nowhere in AFM studies that you need derivation of formulas. Okay, if you want to learn how the formulas are derived, obviously you can learn it separately, but AFM exam doesn't give you any information how these formulas are derived. Okay, so as far as your question is concerned, it's value of call and put option. Value means premium. They are calculating the premium. Abdul Wahab, yes, in CB exam as well as in manual exams, all these tables and formulas will be given. Okay, so let's move towards a question. I'll show the question on this CB platform as well. And you people have the day 4 notes as well in the tab. So you can see the question from there as well. Exhibits and requirement. So the question states, Alaska Salvage is in discussion with potential lenders about financing an ambitious 5-year project searching for lost coal in the Central Atlantic. The company has had great success in the past with its various salvage operations and is now quoted on the London alternative investment market. The company is currently financed by 120,000 equity shares trading at 85 per share. So currently the company is financed by 120,000 shares trading at 85 per share. So current share price $85 per share. It's very important that I keep on noting the information as I get. So Alaska Salvage is in discussion with potential lenders about financing an ambitious 5-year project searching for lost coal in the Central Atlantic. Company has had great success in the past with its various salvage operations, is now quoted on the London investment market. Company is currently financed by 100,000 equity shares trading at $85 per share. It needs to borrow 1.6 million and is concerned about the level of fixed rates being suggested by the lenders. After lengthy discussions, the lenders are prepared to offer finance against a mezzanine issue of fixed 5-year loan notes with warrants attached. Each loan note, repayable at par, would carry a warrant of 100 equity shares at an exercise price of $90 per share. Okay. The estimated volatility of the returns on company's equity is 20%. Volatility is deviation. Okay, it's 20%. And risk-free rate of interest is 5%. So risk-free rate, it's 5%. Okay. And the company does not pay dividends to its equity investors. Okay. The company does not pay dividends to its equity investors. You may assume that issue of these loan notes will not influence the current value of firm's equity. Now, the question states there is a company, Alaska Salvage. Okay. It's in discussion with potential lenders about financing an ambitious 5-year project searching for lost gold in the Central Atlantic. The company has had great success in the past with its various salvage operations and is now quoted on London alternative investment market. Company is currently financed by 120,000 equity shares trading at $85 per share. Okay, so current share price was $85 per share. It needs to borrow 1.6 billion. Is concerned about the level of fixed rates being suggested by lenders. Okay, so each $100 loan note repayable at par would carry a warrant for 100 shares at an exercise price of $90 per share. Okay, exercise price is 90 per share. The estimated volatility, you are given with volatility, that's 20%, and risk-free rate is 5%. The company does not pay dividends. Okay, let's move towards the requirement. Estimate using Black-Scholes option pricing model is appropriate. The current value of each warrant to lender, noting the assumptions that you have made in your valuation. So you need to note the assumptions as well. I will tell you assumptions. And estimate using Black-Scholes option pricing model the current value of each warrant to lender. You need to find value of each warrant using Black-Scholes model, value of each option. Okay, so you need to estimate using Black-Scholes the current value of each warrant. So let's start the steps. I told you that the step 1 is find PAPRST. So PA is the current share price, called PA. Okay. Exercise price is 90. That's PE. Risk-free rate. That's R. What was the risk-free rate? 5%. Okay. Then volatility, standard deviation, that's S. It's 20%. And time to expiry. All this would be given in question. If anyone asks how did this value come, I have one answer. It's given. Okay, so this is the first step. Current share price, the exercise price, the risk-free rate, the time to expiry, and the standard deviation, because the question asks you to find the value of each option using Black-Scholes. So if you want to find value of any option through Black-Scholes, it's 5-step approach. Step 1, PAPERST. You have got the PAPERST. Exercise price is given. It's 5 years. Okay. Now step 2 states you need to find E power minus RT. You know, in Excel, we use the power sign. Okay. So exponential value is 2.7183. Okay. Power minus R directly. So R is 5%. Steric T is 5 years. Okay. 0.7787. Now, one thing I want to inform all of you. There are many people asking that do we need to show the formula separately? On Excel working, you don't need to show the formula separately. You can clearly see that here, if the marker clicks on it, he gets the formula that a student has taken 2.7183 power minus R 0.05 T steric 5. So there's absolutely no need to show this. Otherwise, you need to remove the equal to sign so that it is clearly visible, and then write the answer as 0.7785. If you want to write like this, it's up to you. We just want to apply it in the formula so that when the examiner clicks, he gets the formula. It's up to you. I don't have any problems in anything. Okay, sorry, 0.7787. Okay. No, marks won't make any difference. You apply the formula or you just write it separately. Shilpa, the value means premium. Either you just change my approach and write in step 5 that we are finding the premium of call and put option, or the value, because value is premium. Nauman Shahid, Black-Scholes can be used to value any commodity, equity, gold, crude, wherever someone is giving you right, not an obligation. You can apply these up there. You can apply it in currency markets as well. Someone gives you right to buy dollar, right to sell dollar. That's an option. Then step 3. It's D1 and D2. Okay. Now for D1 and D2, you can use the formula. The formula is the present. I've told you on the exam sheets. C, ln numeric log PA over PE plus R plus 0.5 S square into T over S root T. So let's find D1 first. It's ln PA. What is PA? 85 over PE 90. Bracket close. Plus R. which is 0.05 plus s square. S is 0.2 square power 2 into 0.5 bracket close t is 5, okay, divided by s root t. So what is s? 0.2 root. For root we take power 0.5 t. So multiply by root t. So you need to take the root of t. It's 5, 0.5. Okay. Whatever value you are getting for d1, whatever value you are getting for d1, I have an advice for you that d1 value must be restricted to 2 decimal places. Okay, I'm getting the d1 value. Let me calculate. As 0.64444. I won't take too many decimal places. I would take up to 2 decimal places. 0.644 means 0.64. Okay, and for d2, it's easy. It's d1 minus s root t. So what is d1? 0.64. Take to 2 decimal places minus what is s? 2 multiply by root t. So 5 is the t, and for root power 0.5. Okay, this value is coming 0.19. Even if this is coming more than 2 decimal places, you need to restrict d1 and d2 to 2 decimal places. Remember this thing carefully. Okay, d1 and d2 must be restricted to 2 decimal places. So it's 0.64 and 0.19. Okay. Now move towards step 4. You need to find nd1 and nd2. Okay. Now nd1 d2 is the normal distribution value. nd1 and nd2 is the normal distribution value. I will just explain you how it comes and you can then copy. Okay, how does nd1 and nd2 come? Okay. Now for nd1 and nd2, you need to first find what was d1, what was d2. Pay attention to this. For nd1 and d2, you first need to find what was d1 and d2. So d1 was 2 decimal places, 0.64, and d2 was 0.192 decimal places, right? For nd1 and d2, you need to first note what is d1, d2, 2 decimal places. Okay. Now, once you got d1 and d2, you need to break them into single decimal and multiple decimal, right? 0.64 should be broken into one single digit decimal figure, 0.6, and 1.04. The total is 0.64. And d2 shall be broken into one single digit, one double digit, 0.1 and 0.09. How should I know that? The question came. Let's suppose d1 is 0.23. How will you break 0.23? 0.2 and 0.03. Let's suppose it's 0.71. How will you break? 0.7, 0.01. Let's suppose it's 0.65. How will you break? 0.6, single decimal, 0.05. Let's suppose it's 0.83. How will you break? 0.8, 0.03. So for ND1 and D2, you first need to find D1, D2, 0.64 and 0.19, and break it into single decimal and double decimal. And then go to the normal distribution table. Let's go to normal distribution table. Now, in this normal distribution table, you can find that the rows are of single decimal places and the columns are for multiple decimal places. Okay, so firstly, you need to find ND1. So ND1 for D1, it's 0.64. You broke it into 0.6 and 0.04. Go to the intersection of 0.6 and column of 0.04. So 0.6 and 0.04 intersection gives 0.2389. 0.6 and 0.04 intersection gives 0.2389. So for ND1, the intersection of 0.6 and 0.04 gives 0.2389. Okay, but read this note also. This table can be used to calculate ND, the cumulative normal distribution function needed for Black-Scholes model. If D is greater than 0, means positive, add 0.5 to the relevant number above. If D is less than 0, negative, subtract the relevant number from 0.5. Was your D value positive or negative? Your D value was positive 0.64. So add 0.5 to the relevant number above. This makes it 0.7389. And please pay attention. For ND2, what was D2? 0.19. Broke it into 0.1 and 0.09. So at the intersection of 0.1 and 0.09, you are getting 0.0753. At the intersection of 0.1 and 0.09, you are getting 0.0753. So note 0.0753. And since this was positive, add 0.5 to the relevant number, 0.5753. Okay, so ND1 is 0.7389. I will enter it here. And this is 0.5735. Okay. Any questions with ND1 and ND2 or in the first 4 steps? Yes, because now the lab is better. Almir, because the exercise price is given 90 per share. The current share price is given 85 per share. That's why it's share. MD Fazlul 2.7183 is the calculative function for exponential value. It's a constant. You can check the calculator for it. Agnes, we will shed a light on the NPV stuff as well. Yes, doesn't matter round up or down. Thank you, Shilpa. Yes, Mira, it is possible that one value is positive and one is negative. So it doesn't matter if, let's suppose, the answer would have been negative 0.19. I would have broken this negative 0.19 into 0.1 and 0.09. Go to the distribution function to find 0.1, 0.09. Whatever the number is, since your D value was negative, deduct 0.5 from the relevant number. Charity, we didn't get PAPE, we just knew the abbreviations. It's given in the question. PA is current share price and P is the exercise price. Both will be given in the question. Okay, so using Black-Scholes model, you were asked to find the value of option. I told you about finding the value of option, that whenever you want to find value of option, you need to show 5 steps. Current share price, exercise price, PAP given in the question, RST, all these would be given in the question. Step 2E, 2.793 constant minus RT power, it's 0.7781. D1, D2. D1 formula is given and D2 is given. ln 85 over 90, PA over PE, plus 0.5, 0.05, that is R, plus S square into 0.5 T divided by S root T. You get D2, D1 minus S root T. ND1 and D2 is a bit tricky. So for ND1 and ND2, I told you that you need to find D1 and D2. D1 is 0.64, D2 is 0.19. Break into 2 decimal and 1 decimal stuff. 0.64 is broken into 0.6, 0.04. 0.19 is broken into 0.1 and 0.09. Go to distribution table to get 0.6 and 0.04 and 0.1 and 0.09. Know the relevant number. If your D value was positive, add 0.5 to the relevant number. If it's negative, deduct 0.5 from the relevant number. Okay. Now the last step, find value of option. So the value of option, how to get that? The formula would be given in the exam again. See, the call option value formula is this one. C is equals to PA and D1. Minus PE into ND2 into E power minus RT. Okay, so apply the call value form. Call option value is equals to PA. What is PA? It's 85. Steric ND1. What is ND1? 0.7389. Minus PE. What is PE? $90. Steric ND2. What is ND2? 0.5735. Steric E 2.7183 power minus RT 0.05 into 5. Okay, you get the call option value through BSOP. This is coming 22.48. Okay, so this is how we compute the value of option through Black-Scholes, and it carries some easy 8-line marks. Okay, if you have any questions, please ask, and we will take a break here and then meet. Okay. Okay, so we will be resuming now. And I shall firstly answer the questions regarding this. Okay, now, so let's answer the questions. And d2 value will become positive because if d2 is negative, Shilpa, then you will deduct 0.5 from the relevant number. So the value will be positive of nd1 and d2. Yes, Mira, you're right. MD Fazlul, if you break d1, d2 into 0.6 and 0.04, you go to the distribution table to see what's the value coming at 0.6 and 0.04 intersection. And whatever the value is coming, if your d value was positive, you add 0.5 in that number, and if it's negative, you deduct 0.5. Okay. Odema, if a variance is given, we take root of the variance to get standard deviation. Amsal, so we already got T. I did it second time. You don't want to do it. It's up to you. It's a per issue. FNWA call option value just carries the formula of C. It's PA85 into ND1, 0.7389, minus PE, that's 90, into ND2, that's 0.5735, into E minus RT. Ahmed Junaid, it's the premium. Mohammad Yunus, second step, it's just E minus RT. E value is constant, 2.7193, and you just need to take power minus RT. Yes, Usman, you can use. Frederick, the formula sheet doesn't have only the formula of call option. You can see I've just opened the screen. It has the put option value formula as well. Yes, Goliath's premium. Prita, it's options to buy or sell shares. It's the normal distribution value. Options or real options are the same thing, Shilpa. If Inva, I have done nothing as far as step 5 is concerned. It's the call option value formula which you are seeing on the screen. It's PA, you already have PA, multiplied by ND1, you already have ND1, minus PE, you already have PE, into ND2, you already have found ND2, into E minus RT, you already have found E minus RT in step 2. So it's just value placement. Yes, Kulia, you are right. Okay, in this part A of the question, yes, Salima. Since the values you placed 85 and 90 are the per share values, so that's the premium is also per share. Now, one thing that the question told you in this, part A, that you need to show the assumptions as well of Black-Scholes option pricing theory. You need to show the assumptions as well. Now, one thing before discussing assumptions, I want to tell all of you, always remember one thing. In practical world, there are two types of options. One is called American style options, and the other one is called European style options. Okay, in real world, there are two types of options. One is called American style options and one is called European style options. Okay, the only difference between American style options and European style options is that in American style options, you give an expiry period. Let's suppose the expiry is 5 years. It can be exercised anytime during those 5 years. Okay, remember when someone gives you right that, okay, I will give you right that you can buy gold worth $500 from me. I'm giving you right. If prices increases, you can exercise and then sell to one gain. If price decreases, you can leave it against some premium. Obviously, this option won't be valid for lifetime. It will have an expiry period. Okay, so American style options give an expiry period of, let's suppose, 3 months. The difference is that they can be exercised anytime during those 3 months. But European style options, if the expiry period is 3 months, they can be exercised right at the end, last day of the third month. Okay, let's suppose someone gave you that I'm giving you a right, but the expiry is, let's suppose, 30th January 2021. Expiry is 30th January 2021. American style options can be exercised anytime in between that 30th Jan 2021. But if the options are European style options, then if the expiry date is 30th January 2021, you can only exercise till 30th January 2021, only on that date. You cannot exercise them before. Okay. BSOP model, this Black-Scholes option pricing theory. This BSOP model is only for European style options. This BSOP is only for European style options. Okay. BSOP can't handle American style options, which have an expiry date of 30th Jan and can be exercised anytime. For American style options, we use an approach called binomial approach, but that is not a part of your P4 exam. That's why you don't need to panic that I haven't heard of binomial anytime in my studies. So binomial approach is not a part of your syllabus. That means American style options can't come in your exams. Can only be tested European style options. Okay. Okay, Black-Scholes models assumptions. Assumption number one, the warrant is a European style option. This is Black-Scholes assumption number one. It cannot handle American style options. It can only handle European style options. Okay. Second assumption, the share price follows a log normal distribution and is continuously traded. BSOP assumes that share price is continuously traded. There isn't any time period where trading stops. The trading continues. Okay. Third, unrestricted short selling is permitted. What is short selling? We will discuss it later, most probably tomorrow. There are no market frictions such as taxes or transaction costs. You have just studied BSOP formula. No taxes, no transaction costs. This is an assumption that can't be any transaction cost or taxes. And assumption number 5, no dividends are paid during life of warrant. Now this is very interesting. When you get a right to buy or sell for shares, you have just taken the right, not an obligation. What happens if dividends are paid? Who will claim those dividends? This will create a dispute. Therefore, BSOP assumes that there is no dividend paid during the life of warrant. Okay, so basically, when we talk about BSOP, whenever a BSOP question comes, 95% cases it is asked for assumptions. Okay, so make sure you know the assumptions, you learn the assumptions. About short selling, I will discuss it later. You can ask any questions, else I can move forward. Note this, please. In the meantime, I can answer questions. You can copy this. In the meantime, I can answer questions. Mumtahina, assumptions and limitations are the same thing. Assumptions, limitations are the same thing. Christina, it is not possible to break 0.65 forward in the ND table. I told you when calculating that D1 and D2 must be restricted to 2 decimal places. 0.65 for it must be restricted to 0.65, and then you can break it into 0.6 and 0.05. Yes, Mira, it's just copy paste the limitations or assumptions. Yes, swap. It's like borrowing or deposit. Arun, I will tell you, wait, please. However, if you are unsure, the best thing is to get both. There's a very interesting question coming from 3 or 4 students. That's why it is good that I answer it. However, this should not be the question which you ask right at the date when exams are near. It's a very common question which should have already come in your mind way back when you were studying, and you should have got the answer at that time. Not the type of question which I expect from students at the moment. Still, there are many people asking, will PA will always be less than PE, or it can be other way around? Now, basically, frankly speaking, if I'm studying, I won't worry about it. I just need PA, PE, which one is less, which one is more. That's not a point to panic. So, but still, logically speaking, PA is the current share price, and PE is the exercise price. Logically speaking, current share price should be lower than exercise price. Because let's suppose exercise price is 90, okay, and current share price is 95. Let's suppose exercise price is 90 and current share price is 95. What will people like you and me do? They will exercise at 90 and immediately sell in the market at 95 and get $5 gain. So no one will allow you this. So obviously exercise price will be more and current share price will be less, so that if you immediately exercise, you don't gain. Okay, now we have studied investment appraisal in the first session, and obviously you might have a complete command about investment appraisal, but remember one thing, there are options sometime in investment appraisal also. Now options can come in any topic, okay? This is incorporated in our daily lives in such a manner. Let me give you an example. Options are now being considered in airline industry, okay? Let's suppose you are searching for a ticket, US to UK, okay? And you find that ticket is $800. For example, you are searching for an air ticket. Options have been incorporated in our real lives as well. Let's suppose you're searching for a ticket from US to UK and you saw on the website that the ticket is $800. Okay, you book it. What happens? Sometimes the next day rates go up. You're very happy. Yes, I booked the ticket for $800 and the prices are now $900. But sometimes what happens? You booked a ticket for $800 and the next day you checked, it was $700. You said, oh, what have I done? So whenever you go to any airline website these days, I've checked this myself. Let's suppose a ticket is for $800, you can buy it, but airline gives you an option that you can hold this ticket for 96 hours. Hold this ticket for a week. You just hold it. Hold it means get a right to buy this at $800. Hold it means get a right to buy it at $800. What if prices increase after a week? you can exercise that right and buy it for $800. But let's suppose ticket prices become $600. You made a commitment, a right, a hold to buy for $800. Now the price is at $600. Leave that. Okay. Airlines won't give you this option for free. If you hold ticket, get a right to buy $800, they demand some $10, $20. See, that's premium. And how the premium is computed? Through blockchains. Okay. So options is everywhere. Like options is in currency, you discuss currency options. Option is in interest rates, you discussed interest rate options. Now there are sometimes options in investment appraisal. There are sometimes options in investment appraisal. Okay. In investment appraisal, you can face three options: option to delay, option to expand, option to early exit. Now, what is this option to delay? You are about to start a project next month. You are about to start a project next month. Okay. Someone comes and says, you are starting next month. Better delay till winter season. Better delay till winter season. You will get good returns. Now, is this a force measure? Delay it? No. It's just giving you an option that you can delay it. Option to delay means start project a bit late. Okay. We always have that option in investment appraisal. Now, whenever you plan to start a project next year, maybe you always have the option that you can delay it, start after 2 years, after 1.5 years. Sometimes in investment appraisal, we get an option to expand. Sometimes in investment appraisal, we get an option to expand. Now, option to expand is invest more funds or in more areas. Invest more funds or in more areas. Like, for example, you plan to invest in UK market. There's always an option. You can enter into Scottish market as well. Okay. Let's suppose you plan to enter into 3 cities. There's always an option. You can enter into 5 cities. So this is the option to expand. And the third option, option to early exit. Sell project to someone before completing life cycle. Like, for example, you started a project considering the life will be 5 years. It became a big hit. And after 2 years, some competitor gave you an offer that sell this project to me, take money and leave it. This is called option to early exit. Okay. Now, since option to delay means you will invest funds late, invest funds. It's a call option. Investing means you're buying, investing, giving money for buying. It's a call option. Okay. The PA of this option is considered the initial investment. Sorry, PE is the initial investment, and PA is considered to be present value of returns from initial investment. You need to learn these. Okay. Option to delay, starting project a bit late. This is considered a call option. PE of this option, the exercise price of this option is the initial investment, and PA is the present value of returns from initial investment. Option to expand. Option to expand means expand, invest more funds or in more areas. Since it also involves investing, this is also considered a call option, where PE is believed to be additional investment and PA is the present value of returns from additional investment. Okay. and option to early exit. Here you are not investing. Early exit means you are not investing. Someone is giving you money to early exit. Since someone is giving you money, you are selling project before expiry date. So selling means this is the put option. PE of this option is the government or competitor offer, and PA is the present value of opportunity cost. Because once you take that option, sell early, you lose future cash flows. This is an opportunity cost. Okay, you need to memorize these things, and then I will explain you a question in detail about it. Evelyn, we found the value of the warrant. Warrant was the option, 22.48. Riam, if you take option to exit, means you have to sell project. It's a put option, selling means put. PE is the offer which we are receiving. Because we exercise, we receive money, offer. And PA is the present value of opportunity cost. PE is the additional investment, and PA is the present value of returns from additional investment. Redeploy is not in your syllabus, Montana. Okay, so I told you that when you are doing appraisal, because when you are doing currency risk and interest rate risk, in both you studied options. Okay, so there are options in investment appraisal as well. Whenever you are investing somewhere, there is always an option that you can delay, start a bit late. Since involves not selling, giving money, buying, it's a call option. The PE of this option is called initial investment, and the PA is the present value of returns from initial investment. Learn these, okay? In case of option to expand, there's always an option that when I'm investing somewhere, I can invest in more areas, more funds. Since it also involves not selling but investing, buying, it's a call option. PE is the additional investment, and PA is the present value of returns from additional investment. Okay, and the third option is option to early exit. Sell someone to government or competitor, because sometimes the project's life was 5 years but it became a big hit. You can sell it early. It's considered selling. Selling means put option. PE is the government offer or competitor offer, whoever is buying, and PA is the present value of opportunity cost, because once you take this option, you lose further money. It's opportunity cost. Okay. Okay, now just to give you an idea of this, I won't solve the full question because you know how things work. Just to give you an idea. The question in front of your screen is that Warsaw PLC is considering a new project which requires an initial outlay of $10 million. You are considering a new project which requires an outlay of $10 million and has an expected NPV of $2 million. Okay, Warsaw is considering a project which requires an outlay of $10 million and has an expected NPV of $2 million. Outlay is 10 million, investment and NPV is $2 million. However, the economic climate over the next few years is thought to be very risky and the volatility is 20%, deviation is 20%. Warsaw is able to delay commencing the project for 3 years. You can delay the project for 3 years. Risk-free rate is 6%. Okay. You are required to estimate the value of option to delay the start of project for 3 years using the software. You are required to estimate the value of option to delay. Now, in this question, the requirement states you are required to estimate value of option to delay project. Requirement states, here's the requirement, you are required to estimate value of option to delay. I've been asked to estimate value of option to delay. I've been asked to estimate value of option to delay using BSOP. Had the question not told about BSOP, still I would have known that if I need to estimate the value of option, any option is found through BSOP. So you are required to estimate value of option to delay. Now, if the question asks you to estimate value of option to delay, remember by my notes, the question asks you to estimate value of option to delay. Option to delay is a call option. I just told you, only option to early exit is a put option because in that you are selling, otherwise you are not selling anything. So you are required to estimate value of option to delay. Option to delay, it's a call option. Hence, value will be found through BSOP. Option to delay is a call option, right? You are asked to estimate value of option to delay. Option to delay is a call option. So hence value will be found through BSOP. And once you decide value will be found through BSOP, once you decide value will be found through BSOP, you know there are 5 steps. Once you're finding or is required to estimate value of option to delay. So option to delay, it's a call option. So value will be found through BSOP. And once you have decided the value will be found through BSOP, you have just been taught 5 steps. The golden step is step 1, find PA, PE, RST. Step 2, E minus RT. Step 3, D1, D2. Step 4, ND1, ND2. And step 5, call option value because this is a call option. How to get PA, PE, RST? R is the risk rate given 6%. S is the volatility given 20%. T is the time to expiry. Can delay for 3 years. PA, PE you need to memorize. I've already taught you. PE of this option is the initial investment. So what is the initial investment? 10 million. PE is the initial investment. What is the initial investment? 10 million. Line 1, Warsaw is considering a project which requires outlay of 10 million and has an NPV of 2 million. So PE of this option as taught to you is initial investment 10 million and PA is the present value of returns from initial investment. So if 10 million is the investment and 2 million positive is the NPV, so present value of returns is going to be 12 million. If PE initial investment is 10 million and NPV is 2 million positive, so the present value of returns is going to be 12 million. Okay, then you know E minus RT, the D1, D2 formula, the ND1, D2 and the call option value. This is how you deal with option to delay, expand or early exit. whatever option is, either it should be a call or a put. You need to find value through BSOP. 5 steps. Step 1, RST would be given. PAPE, I have told you to memorize what are they, and that's it. Okay, you can note this. If you have any questions, please ask. Okay, Finwa, wait, please. Aman Bafra, you are getting the wrong values. Yes, Finwa, you will get either option to delay or expand or early exit. And you will use BSOP. Yes, Salima, yes. Yes, Ipinwa, either you will get delay, early exit, or expand, and you need to find value through BSOP. These 5 steps need to be applied. In step 1, PA, PE, RST should be used. RST would be given, and I've told you specifically what is PA and PE for each option. Okay, now the question stated, listen carefully, many people are asking me that PA is 2 million. No. PE is 10 million, right? What is PA? Present value of returns from initial investment. PA is not the NPV. I didn't tell you the abbreviation that PA is the NPV. Okay. I told you PA is the present value of returns from initial investment. Now let's suppose the project life is 3 years. Okay. And you get net cash flows multiplied by discount factor to get present value. And the net of all is NPV. Okay. Now NPV is 2 million positive. Okay. And initial investment which comes in year 0, it's 10 million. PA stands for present value of returns from initial investment. So what would be the present value of returns? These returns, they have to be 12 million. So that 12 minus 10 gives you NPV of 2 million positive. The meaning of PA is not NPV. It's the present value of returns. So if investment is 10 million and NPV is 2 million positive, the returns you got is 12 million. Okay. Any more questions on this 12 million? No, it's not being delayed by 3 years, else we would have done this. It's already present value. You need the present value of returns for initial investment. So we will be shifting from BSOP now. and move towards our last topic, that is mergers and acquisitions. Okay, we will discuss the past paper question of this tomorrow, but I just need to explain you some theory of mergers and acquisitions. Okay, so as far as this mergers and acquisition is concerned, the main story of merger and acquisition is that there is a company, let's suppose A, it wants to acquire company B. Listen this theoretical stuff so that you get help with the past exam question, which I would be doing in our tomorrow session. The main story of mergers and acquisitions is that there is a company A, okay, and it wishes to acquire company B. There's a company A and it wishes to acquire company B. Please don't ask questions on WhatsApp group. I've told this multiple times that the question needs to be answered here. So there is a company A. It wishes to acquire company B. Okay. So remember, if company A wishes to acquire company B, it will become a big company. A plus B. If company A wishes to acquire company B, it will become a big company, A plus B. Okay. So people say if company A acquires company B, how will it acquire company B? Remember, company A would not acquire assets of company B. It would not acquire liabilities of company B. It would just acquire shares of company B from shareholder. Correct? It would just acquire shares, equity. Because once you get the shares, all assets and liabilities are yours. Remember? Assets. So capital, equity is assets minus liabilities. So once you get this capital, this equity, assets and liabilities are all yours. So remember, if someone asks you that I'm acquiring company B, what should I acquire? It's land, it's machinery, it's property, it's liabilities, it's debtors. No, you should acquire shares from shareholders. Because once you get equity, all assets and liabilities are yours. Okay. Now, if company A acquires company B, that means it acquires shares of company B from shareholders. It has to pay something to shareholders in return. Obviously, if company A wishes to acquire company B, and for acquisition, it wants to take shares from companies B shareholders, it has to pay something in return. Okay, what it will pay? The usual options are cash offer, share for share exchange, and bond offer. The usual options are cash offer, share for share exchange, and bonds offer. Copy this so I can explain it to you. Okay, so whenever company A wishes to acquire company B, first thing to note is it will acquire shares. Okay, because if they get the shares, everything will be theirs. Okay, how to acquire shares? They will take shares from companies B shareholders, but companies B shareholders would want something in return. So what are the usual options? Sometimes company A acquires shares of company B from shareholders by a cash offer. What is cash offer? Give them cash. Take shares, give them cash. Okay. Sometimes company A wishes to acquire company B, take shares from shareholders, not by a cash, but by a share for share exchange. What is a share for share exchange? Take the shares, take their shares, and give them shares of the new combined company in return. This is called share for share exchange. Okay. And the third offer is called bond offer. Okay. You take the shares of company B's from its shareholders and give them bonds, interest bearing instruments in return. Now, people sometimes ask, which is the best one? Now, frankly speaking, this is a matter of big discussion, because in some cases, cash offer would be good. In some cases, shares offer would be good. And in some cases, bond offer would be good. Okay. So when you take shares of company B from its shareholders and give them cash, this is called a cash offer. When you take shares from company B shareholders and give them shares in return of the new company, this is called share for share exchange. There is a ratio set in that. And when you take shares from company B shareholders and give them bonds interest bearing, this is called a bond offer. It entirely depends on the corresponding party. Sometimes there are some shareholders who wish cash against their money. They give shares and take cash over. Some want to remain in the company, so they ask for shares in return. And some who want interest, capital protection, they are given bonds and they regularly get interest. However, if you take bond offer, obviously you won't have any rights in the company's ownership for future. Okay. Again, before acquiring any company, one more thing is done. Valuation is done. That is, value is found. For that company. Okay. Once valuation is done, obviously valuation means finding value. I am wishing to acquire one company. Obviously, I will do valuation. I want to find value of that company to decide whether to buy it or not. The valuation of the company is done via different valuation methods. The valuation of company is done via different valuation methods. The most commonly used is FCM, free cash flow method. Okay, I will explain you this method today so that we can do question properly in future classes. Okay, so whenever I want to acquire a company, I will acquire the shares. Again, shares I will sometimes pay cash, sometimes shares, and sometimes bonds. Okay, it entirely depends on the shareholders what they want to. When I will acquire any company, I will find the value of that company. Valuation is done, and the most common valuation method is called free cash flow method. Okay, any questions up till now? Okay, charity in share for share exchange, we take shares from companies, we shareholders, and don't give them cash, don't give them bonds. In fact, give them shares of the new company remain, so that we take over the previous company. We take over the previous company, and the shareholding is finished. But now they're adjusted in the new company by giving them some shares of that new company. Yes, FCF method or discounted cash flow method, they both are the same. Okay, now there are 2 or 3 students asking that there are many confusions regarding mergers and acquisitions. So how to deal with it? Now, let me tell you one thing, mergers and acquisitions is a deep sea. Now, what is the meaning of deep sea? Like you will pick any AFM student and ask him which area you find the most tricky in AFM, and he's gonna obviously tell you mergers and acquisitions. Now, I'm not talking about 1 or 2 students, that's about the majority. Almost everyone says mergers and acquisitions is tricky in the exam. Now, what is the main reason? Now, the tendency of students is to understand those topics easily, which are format based or standardized. That's your tendency. That's my tendency, that we basically prefer those topics easy, which carry a standardized pattern. Like, no one finds investment appraisal confusing. No one finds investment appraisal confusing. Why? The main reason why you don't find investment appraisal confusing is that investment appraisals, every question is standardized. You have to make the columns, the investment, the revenues, everything. It's exactly the same. Okay. Now, same goes with the risk management. You would hardly find any student who says that I found risk management difficult. Why is the case so? That risk management is difficult. I don't find risk management difficult at all. Now, why you don't find risk management difficult at all? Because no matter how technical it is, ultimately you have to mention those 7 steps, those 6 steps, those 4 steps, and that's it. The risk management is done. But BSOP, okay, BSOP will always be this 7 to 8 step, right? The 5 steps I told you, sorry. So people find risk management, interest rate risk management, currency risk management easier because they consider it standard based. Okay, but when we talk about this mergers and acquisitions, every pattern is different, every question is different, every style is different. There is no standardized pattern, no standardized format, and that's the main reason people say, okay, we find it very difficult. So that's the reality, that it's because of your tendency you are considering it difficult. It's not difficult at all. Okay, try to do whatever you know in that question. Try to do whatever you know in that question, and I challenge you that if you do the maximum things, you will gain the maximum marks, if not all. But if you just leave around, roam around, obviously it's going to be suffering for you. Okay, and secondly, because risk management questions are differentiated from each other, so again, many students want to do that question in the exam or that question in the webinar, which they find difficult. So obviously it is not possible, because I've got around 10 question names in the comment section. I've got around 10 question names that people want me to solve. So obviously I have to select one from it. Okay, so that's why WhatsApp group is there as well. Okay, anyways, you can ask other questions there. So what does this FCF method say? The FCF method states a business is worth the discounted value of its future free cash flows. Okay, this method believes business worth is equal to the future free cash flows it generates. Okay, like you might have studied dividend valuation model, which it's an easy model, not going to cover here in this webinar. Like dividend valuation model believes the value of the business is worth the future dividends. The net assets valuation method believes that the value of business is worth the net assets. So free cash flow method believes the value of the business is worth the discounted value of its future free cash flows. But always remember, there are two approaches. Okay, one is called FCF to company and one is called FCF to equity. One is called FCF to company, one is called FCF to equity. One method is called FCF to company and one is called FCF to equity. Okay, now what is the difference? Please pay attention. In FCF to company, the first column, please pay attention to the first column. In FCF to company, the value of business is computed like this. In FCF to company, you take revenue of that company, okay, future revenue, right? Because business is worth the future cash flows. So you take the future revenues, deduct cash costs, and deduct tax allowable depreciation. Okay, deduct revenue, future cash cost, future TAD, tax allowable depreciation. No interest is deducted, you get taxable profit. Okay, from that taxable profit, you deduct the taxation. Then you add back tax allowable depreciation, because depreciation is a non-cash item. We did this in investment appraisal as well. First deducted, then added back. Then you deduct investment in NCA, non-current asset. Then you deduct investment in working capital. You get FCF to company. Then you FCF to company, when you multiply it with discount rate, that is company's WACC. You get the value of entity. Okay, repeat. You take future revenues, deduct cash costs, deduct tax allowable depreciation. No interest is deducted in this method, you get taxable profit. Then you deduct tax, add back tax allowable depreciation, you deduct investment in NCA, non-current assets, investment in working capital, you get FCF to company. You discount it by the company's WACC to get value of entity. Then you deduct VD, value of debt, to get the value of equity. You deduct value of debt to get the value of equity. Now the other method, FCF to equity, please pay attention to the difference. In this also, you note down future revenues, deduct cash cost future, deduct future tax allowable depreciation, but you deduct interest here. In FCF to company, there was no interest. That's how you deduct interest. You get taxable profit, then deduct tax, then add back TAD, then deduct investment in NCA, and then deduct investment in working capital. You get FCF to equity. Now, at this moment, there is only just one difference. Till now, there is only one difference, that in FCF to company, we don't take interest, and in FCF to equity, we take interest. At the moment, there is only one difference. In both options, revenue comes. In both options, cash costs come. In both options, tax allowable depreciation comes. But interest doesn't come in FCF to company, and interest comes in FCF to equity. And you get both taxable profit, both has tax, both has add TAD, plus investment in NCA, investment in working capital. You get FCF to company there and FCF to equity there. The second difference. When you get FCF to company, you multiply it with the discount rate of company's WACC. But in FCF to equity, you multiply it with KE, the cost of equity, to directly get the value of equity. Whereas in that, you get value of entity, then deduct value of debt to get value of equity. Okay. So you need to record the future revenues. You need to record the future cash costs. You need to record the future depreciations. Then take interest in FCF to equity, but not in FCF to company. Sorry. So there are two differences. The first difference is you take future revenues in both, future cash costs, future depreciation. In one case, FCF to company interest doesn't come, but in FCF to equity interest comes. You get taxable profit, pay tax, add back TAT less investment in NCA, investment in working capital. You get FCF to company and FCF to equity, discounted by company's WACC, discounted by K to get value of entity, deduct value of debt to get value of equity, and their only value of equity. Okay, any questions on this, please ask. Things will be more clear when you give the question. Yes, Sufyan, I can share. I will share it, don't worry, Arun. Value of entity means the whole entity's value, including debt. Now, Raqib Zaman, your question is very good. I will just explain it after 2 minutes. Obviously, there are other methods as well, like the net assets valuation method, which believes entity's value is based on assets, dividend valuation, which believes entity's values is based on dividends. Okay. But FCF method, it believes, is the most lengthy and most commonly used and most commonly tested method that value depends on future cash flows. Okay. Now, the first good question from Rakibun's Zaman, when we will use which one? Now, I have two answers for this and you need to listen both of them. The first answer, the question sometimes clearly mentions that find the value through FCF to company method, and sometimes it states find value to FCF to equity method. So you are very much clear that when the question asks FCF to company, use FCF to company. When the question asks FCF to equity, use FCF to equity. Sometimes it doesn't mention, only says FCF method. You are worried which method to apply. It's very easy. If WACC is given, you can't apply FCF to equity. You have to apply FCF to company. Okay. But if you are given KE, WACC is not given, you can apply FCF to equity only. Okay, so this is the tip. If the question asks FCF to company, easy, use FCF to company. If the question asks FCF to equity, use FCF to equity. But if the question says FCF method, then you need to think that if WACC is given, WACC comes in FCF to company format, you can use FCF to company. But if KE is given, it comes in FCF to equity. Okay. Second good question from Adarito. What is the reason behind deduction of interest? Okay. Now, a good question is why interest is being deducted and why interest is not being deducted. Now, listen carefully. Interest is always included in WACC. Interest is always included in WACC. Since in FCF to company, you are using WACC. Since in FCF to company, you are using WACC. So if we include interest above as well and we are taking WACC as well, interest would come 2 times. So since interest is already included in WACC and you are using WACC, no need to record interest. But in FCF to equity, you are not using WACC. You are only using KE. Interest is not included in that. So you need to deduct interest. Yes, Noman, you're right. Safwan, I haven't seen a question where both is given in the question, but if both are given, then it's clearly mentioned by the examiner that either use FCF to company or equity. No, Frederick, they will come different, because in FCF to equity, the discount factor is K, different percentage, and in FCF to company, discount factor is different percentage. As when I told you, the exam question will always tell you use FCF to company or FCF to equity. If it just states FCF, now you should decide whether to apply FCF to company or equity. If WACC is given, FCF to company. If K is given, then FCF to equity. Now a student is asking that we face a lot of problem regarding in mergers, where to start and where to end. Again, same reply I gave it before. Don't worry about where to start, where to end. You know what things to calculate. Like if the question is asking that find the value or whether this acquisition will proceed, and you see the data of FCF is given, you have to apply FCF method. No matter where to start, where you end, gain maximum marks, because once a student thinks that he has complete command on that question, full marks. But if the student says that I don't know where to start, where to end, then at least take maximum marks. If FCF data is present and you are unable to get the requirement, at least find FCF valuation. You will get majority marks through there. Yes, Shilpa, it's market value. Salima, actually, every step carries marks. So you should write each and everything. Like many people ask this in investment appraisal as well, that why I record revenues, why I record variable costs, why I record fixed costs. I can directly start from contribution or profits, but again, it carries marks. Therefore, I have to show everything, not just directly start from taxable profit. Remember one more thing, the definition. A business is worth the discounted value of future free cash flows. Look at the definition. The business value is the value of its future free cash flows, not the current free cash flows. So make sure you calculate this FCF format, but you have to take future cash flows, not the current cash flows. What I can do is, obviously, we will be doing one question only. Okay, but I just told I have got requests of 12 questions with different names. Please do this question, please do this question. Obviously, only one will be selected, but I will give you some good questions of mergers and acquisitions in tomorrow's session, so that you can at least do that. Questions will help you a lot. Alan Frederick, as far as WACC is concerned, WACC, we have seen some questions, WACC is given, and there are also some questions in which WACC has to be calculated. Obviously, WACC working carries separate marks. Okay, so I think that's it for today. If you have any more questions, you can ask, but we will finally meet tomorrow and do the past paper question practice for it. If Inva daily, I message you my WhatsApp number. Please WhatsApp me. I will add you in the group. You don't read messages, I think. Okay, then I will add you. Don't worry. If Inva, can you just immediately send me again? Maybe I overlooked it. With your name, please. You just please drop me a text immediately. I will share you the group link. If I'm talking to you specifically. Thank you. Dan, I received your message. I'm just doing. Okay, Rakib Zaman will share it to you. Efenwa, I haven't received any of your texts, so let me add you through your number. Can you tell me your complete number with your country code as well? Yes, Aman, you can leave.